From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the latest payrolls report coming in below estimates, boosting bets that the Fed may push through a supersized rate cut this month, sending bonds whipsawing as traders debate the Fed's next move. But we begin with the big issue, a cooling labor market.
What we're seeing is a slowing in the labor market.
There's a slackening in the labor market.
This report is better than in July.
The headline reaction is to the slightly weaker payroll headline.
This is really telling you that there is a soft landing.
Take a deep breath. Things aren't falling apart out there.
The job market is loosening, but not aggressively so.
This economy is not slowing down in the way that markets are anticipating.
The Fed has not had to worry about the labor market for quite some time, but we heard from Chair Powell at Jackson Hole that that's starting to change.
The Fed has stated it's very much concerned about the labor market.
I don't think this report is definitive on the 25 versus 50.
I don't think we're going to get a 50 basis point cut.
The risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
I think there's very little that could move them to 50 in September, despite the fact that we think that that's warranted.
You're kind of on a knife edge right now, and you don't want things to deteriorate further from here.
Now, it's hard to use a moment in time because the bond market has certainly been whipsawing. But what I can tell you is that from the beginning of the week, you have seen the two-year yield move more than 25 basis points lower. Bloomberg's Michael McKee is joining us now to take a look at those moves in the bond market this week, because there were some moments that mattered more than others, and it wasn't always what traders thought they would be.
Well, we had a lot of minor jobs numbers that caused a lot of angst in the markets, and it sort of got priced out yesterday. And then 8:30 this morning, you take a look at the GIP, the one-day charts for a lot of different assets, and it looks like a heart attack, because traders couldn't make up their minds. We had a worse than expected jobs number, but the unemployment rate was better than expected, and the underlying data for unemployment were pretty good. So you take a look at what we've got here, which is basically the heart attack. The white line is the 2-year, 10-year yield curve spread, and it turned positive again, second time this week, and has maintained it, still up about 1.5 basis points over zero. So some people there are thinking, well, the Fed's going to be cutting a lot because we've now re-steepened the curve. And the other line was the number of rate cuts that were expected. And when we got the number, and then when Chris Waller spoke, a lot of people thought that maybe the Fed was going to be cutting rates 50 basis points, but the market's sort of priced that out now. We've almost eliminated the idea of a 50 basis point cut, just 1.2 cuts our forecast. So looks like we've been through the angst, and maybe the patient now can stabilize around 25.
Well, we still have CPI next week. What are the expectations for that?
Really, there's no change. We're going to get a 0.2% change in monthly change in headline and core. The headline year over year goes down to 2.6 from 2.9 because of base effects. No change in the core. So it's just going to tell the Fed they can go ahead with their plans.
McKee, we thank you so much. That is Bloomberg's Michael McKee on all of the movements in the bond market. Joining us now, Gargi Chaudhuri of BlackRock and Leslie Falconio of UBS, because we were talking to Mike about how those moves were not as you would expect it. Even today, the payrolls report, it did cause a move lower in yields, but it then stabilized, and it was those Waller comments that set the market off once again. Gargi, what was the market hearing from him that set this move forward?
Sure, Sonali, it's so wonderful to be here. Good afternoon. So I think when we saw the Waller comments come through at first, especially if you just skimmed the headlines, I think many would have responded to the comment that said front loading of cuts. But if you actually read through, I read that as quite a balanced speech where he wasn't actually committing to either 25 or 50, but just saying that the time has come, obviously, as the topic was, that the time has come to act now. And if data, new data, suggested that they needed to go further in, in the months to come, that they would. But I don't think that speech pointed us to a 50 basis point rate cut. So based on all of the totality of the data that we've gotten so far, I think next week or the week after, we're still looking at a 25 basis point rate cut, or more likely a 25 basis point rate cut from the Fed.
Leslie, what do you think about this idea of that supersized rate cut? Clearly that idea has been gaining steam, and really what you have is Fed swaps really pricing in more than 110 basis points worth of cuts just this year. That is more than they saw when we started the weeks. What do you think?
Absolutely. I mean, I think earlier that they had about 130 basis points of cuts priced in for the remainder of 2024, and that's between, 3 meetings. So we're looking for 100 basis points for all of 2024. Now, after this jobs number, it does lower the probability of a 50 basis point rate cut. More than likely they won't. But I think the way that we're looking at it and the way our economists are looking at it, that one of the variables that really needs to be paid attention to prior to the Fed meeting, besides CPI, is retail sales. We would be having an entire different conversation if retail sales came out weaker instead of showing strength at the last print after a weak number. So although 25 is more than likely, we do think 100 for the years is also fairly likely as well.
That is a wide range of outcomes, and it begs the question. You had Michael McKee talking about stability, general stability. I guess I have my doubts when you've had such volatility throughout the year. Is there a chance, Leslie, that the bond market perhaps is overcorrected at this moment?
Listen, the bond market is forward-looking and the Fed is backward-looking. So the bond market has a tendency, we've seen this all year long, to reprice and recess. And, it's not solely the bond market's fault, because when you continuous dialogue with data dependence, you're going to increase volatility. So in our opinion right now, the bond market is getting ahead of itself, particularly in the short end. When you think about, the 130 for 2024, maybe over 100 in 2025, and a terminal rate right now at about 3.25. But we've seen this before. But the problem is when the guidance is data dependence, you're just going to increase volatility. And I think that's one of the reasons why, although we've seen inflows into fixed income funds, we also, again, have a record high in money market of, 6.4 trillion. So we have to get through that every single data point to have the bond market have a little bit of stability and lower the volatility.
Gargi, the other big story of the week in the bond market was the disinversion of the yield curve. And while we had a historic run with how long that 210 curve in particular was inverted, what do you think it means now that we see it going the other way, a nearly 2 basis point differential between the 2-year and 10-year at this point?
Mm-hmm. Yeah, so one of the longest disinversions in the history, and I think this was a big week for those of us that pay close attention to the yield curve to see that sort of get back into positive territory. Look, I think this is this is the point of the cycle. We're about to get the first rate cut of the cycle, 25 or 50. We think 25, but this is just the beginning, right? So to Leslie's point earlier, we're obviously going to get more rate cuts after this. This is not a one and done type situation. The labor market is cooling. Growth is normalizing. It is softer. And I think that is exactly what the yield curve is pricing in. There are two parts of this, right? So there's why is the 2-year moving the way it is, and then there's why is the 10-year and the longer moving the way they are. And I think when you look at the longer end of the curve, obviously that's driven by a lot of other factors, not just expectations of Fed funds. And this is where some of the dynamics around deficits, et cetera, come in. And to that extent, we think that the curves can probably continue to keep steepening. So not just on the 2 point, which you made earlier, but even if you look at the 5-year and then go out all the way to the 30-year, we actually think that's why the sweet spot right now for investors looking at fixed income is really that belly of the curve, really that 5-year, maybe the 3 to 5-year part of the curve. And you don't have to extend much beyond, we think, the 7-year part of the curve. So steepening probably continues. This is just the beginning. And again, all of this is because we're the market and we are getting ready for this rate cutting cycle.
Now, guys, you mentioned deficit, Gargi. I want to talk a little bit more about the political overlay here, because we did hear former President Trump speak to the Economic Club of New York yesterday, saying he promises that interest rates will go lower. I caught up with one of his informal economic advisors, billionaire John Paulson, yesterday. This is what he said about the direction of interest rates.
My best guesstimate would be around 3%, perhaps 2.5%. It's generally beneficial. The major cost when you get a mortgage is the interest rate. So if the cost of mortgages come down, the cost of buying a home would also come down.
Now, that's by the end of next year. Leslie, do you have that much conviction in the long end of the curve that you could see it really reduce to 2.5%, that the Fed could cut that drastically?
You know, not at the path that we expect growth to be right now, which is, by the way, you know, trend or slightly below trend. If in order for you to have a 2.5% by the end of next year, you're going to have to see, you know, growth slow by more than what we're expecting. And when you look at, say, the credit market or fixed income, they're definitely not pricing in that kind of path, you know, where spreads are right now. So I think that's a little bit too much, you know, given what we know right now. But in order to have a 2.5%, you'd really have to see growth slow substantially and the unemployment rate move up substantially.
Gargi, how do you feel about this? On one hand, there are questions around growth, whether it would ever slow that much into next year. But there are also questions about kind of investing further out in the United States economy when you have a deficit the way it looks right now, and two presidential candidates that are looking to spend some more. So how do you believe in the longer end of the curve, Gargi?
Yeah, that's, you know, to your point around both of the candidates focusing on policies that might add to the deficits is one of the reasons, one of the many reasons I would say, that we are telling investors that if you're sitting in cash, you're not going to earn that full 5% by the end of next year that you were expecting to at this point. So it is time to step out of cash. And obviously, we've seen about $1 trillion in fixed income ETFs. And that is an indication of all of those investors that are moving away from cash into fixed income. So I expect to continue to see investors doing that. But where you own fixed income, really knowing where the duration makes most amount of sense is really important here. And whether it's for the political reasons, whether it's for just the lack of term premium, we still think that the belly currently is the place that you're supposed to invest. Now, I'll also add that, you know, are interest rates going to go lower from here? Do we know exactly? Do we have a crystal ball for what's going to happen in 2 or 3 years? Look, it's really hard to tell. Obviously, between now and the end of the year, based on the data that we're getting, both on inflation as well as the labor market and growth, it is appropriate for interest rates to come down, led by, as we've heard from Chair Powell and others. After that, I think we are yet to see what the neutral rate is. There's been a lot of debate and discussion around that. So whether it is at 2.5, we just don't have enough data on that. The market's pricing in a little bit above 3%. That feels fair. The data will show us the way.
Gargi Chaudhuri and Leslie Falconio, we thank you both for your time. Have a great weekend before a busy week that includes a CPI print next week. Now, up next, the auction block, the U.S. blue chip corporate debt market seeing 2 days of record sales. It's coming in hot. We're going to talk about that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we're going to kick things off in Europe, because another busy stretch of issuance for the banks, dominating sales for the 9th time this year and boosting weekly sales close to 57 billion euro. And in the United States, high-grade bond sales topping $80 billion this week, a historic 2 days of deals propelling the 5th largest weekly haul on record. And in high yield, borrowers coming into the market on Thursday alone, 5 borrowers marking the busiest session in 4 weeks and boosting the weekly tally up to $7.5 billion. Now, Fed Governor Chris Waller setting off the bond market this morning, saying that cuts need to be front-loaded.
I believe that the balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
Now let's bring in Lotfi Karoui, Chief Credit Strategist at Goldman Sachs, and Michael Contopoulos, Director of Fixed Income at Richard Bernstein Advisors. The reason I wanted to bring in that Waller comment is because a question that's been burning for me is how much do rates really need to come down to see a ripple effect? Because if you had mortgages at less than 4% or 4.5%, 6.5% is not going to cut it. Lotfi, where do you need to see rates head to really reinvigorate the market?
I think on the mortgage side, it would take a lot. I mean, the market went through a big affordability shock the past couple of years. Hypothetically, if we move lower by another 25 basis points, it won't change things that much, I think, from an affordability standpoint. On the corporate credit side, I would say, and it's been a consistent theme really year to date, every time you get these episodes of rally, issuers try to take advantage of it and go to the primary market. Now, that's certainly been the case today. So I would say that counterintuitively, a lot of easing has already been delivered in capital markets, even though the Fed is yet to start the easing cycle.
Well, to that end, has too much easing been delivered to some parts of these markets? You see high grade coming through fast and hot, and at the same time, growth seemingly slowing in many areas. Michael, do you bite on risky bonds?
No, not at all. And it's not because, we think there's any sort of imminent recession. In fact, when you look at profit growth is set to accelerate for the next several quarters. And obviously, you want to buy risk. Generally speaking, when earnings are accelerating, the problem is that the relative value isn't there. There are much better options out there with much lower risk than nibbling on risky credit at the moment. You can buy CLOs as an example with better yield and much more protection, much more safety beneath you. And we would like something like that, which is still levered to the profit cycle and reasonably strong data, than just run-of-the-mill fixed rate, investment grade or high yield corporate credit.
Well, even if you are a buyer of high yield bonds, I'm wondering if the spreads really are compensating you for what you're taking on. How do you feel, Lotfi, about valuation for the people who are buyers in riskier parts of the market right now?
It's pretty tight. Obviously, spreads, at a very low end of their historical range. And so there's no doubt that, the asymmetry is negative. The question is, what's the time horizon? And are we close to an inflection point in the cycle that would justify an outright short position on credit? I don't think we're there yet. And so while there's no obvious pocket of dislocation in corporate credit that offers a lot of upside convexity, what we've been focused on really is relative value views within credit. We're very comfortable with the durability of the cycle, and we like to own parts of the market that are poised to outperform as the Fed starts to cut. Example, extend duration, move away from the front end into the belly of the curve. That makes a lot of sense to me. Lean a little bit more on high yield bonds versus levered loans, and so own fixed rate over floating rate structures. That also makes sense. And then still comfortable being down in the quality spectrum in IG and own that BBB part of the market where, by and large, companies have continued to manage capital quite conservatively. And then even if there's a little bit of a downgrade risk, I think most high-yield investors will likely receive fallen angels pretty strongly.
Now, that's a fascinating idea, that one moment you said you wouldn't necessarily short at this moment. Michael, curious, what would it take for you to go short some of the parts of the bond market that you're seeing now, particularly high yield?
Yeah, as long-only investors on our side, we don't really short, more underweight. I agree with some of the things that Lotfi mentioned. I would disagree wholeheartedly with a few as well. Obviously, selection matters a lot more than allocation here. In other words, where do you own your credit risk? Where do you own your interest rate risk? And I just don't think the relative value proposition for owning investment grade or high yield here makes a whole lot of sense when all of your return is effectively coming from the interest rate component, not the spread component. And that's not, historically a good place to sit. So, listen, when would you short? I mean, it's a pretty high carry instrument when you factor in your coupon and your borrow to short high yield. So, it's always a tricky proposition to short credit. But in terms of underweighting, I mean, I don't see any reason why you need to be overweight credit risk here in traditional fixed rate IG or high yield when there's a lot of other options out there, whether that's duration, whether that's mortgages, whether that's CLOs. There are places to find value, curve trades. There are a lot of places to find value that you don't have to take a lot of credit risk.
We have about 2 minutes left here, and I want to hear from both of you on what you guys think the biggest risk is in this market right now. Obviously, so much complacency in the bond market. Lotfi, what might investors be ignoring?
Look, I think credit can withstand a little bit of a slowdown in growth. And so as long as the labor market is cooling down, but we're far enough from the recession threshold, I think credit is okay with that. My biggest concern is really a growth shock into the asset class. Credit, by design, doesn't really capture a lot of the upside. That usually goes to the equity market, but we're a lot more sensitive to downside risk. And I would keep a very close eye on the labor market, of course, but there's a couple of pockets in the economy that we're also following very closely. The low end of the income distribution in consumer, you've seen a persistent rise in delinquencies. That's worth keeping an eye on. But in general, I would say, without a doubt, a growth shock is the biggest risk to credit markets.
Michael, biggest concern?
Well, I'll take the other side. I think a reacceleration of the economic data. The Fed cuts interest rates by 25 basis points, and all of a sudden things start to reaccelerate, right? You have strong earnings growth, and rates start to go up, and the market starts to price in, significantly less easing. You could get a tremendous amount of volatility, both on the rate side and on the credit side, if that were to happen. I actually think both the risk that Lotfi mentioned and this risk are potentially equally detrimental to fixed income.
Spread makes a market. Love the divergence in views. I cannot believe we still have so much of it years into this hiking cycle. Lotfi, Karoui, and Michael Contopoulos, we thank you both so much for your time. Have a great weekend. And still ahead, the final spread, the week ahead. A fresh read on U.S. CPI. We'll talk about that inflation risk. This is Real Yield on Bloomberg. I'm Sonali Basak. This is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Coming up Monday, we're going to get U.S. wholesale inventories, and Apple is holding its iPhone 16 launch event. Tuesday, it's the first U.S. presidential debate, and a lot of eyes on what both candidates are saying about the economy. And Wednesday, all eyes will be on the August U.S. CPI print, plus another round of MBA mortgage applications rolling out. And Thursday, an ECB decision and a Christine Lagarde news conference. And Friday, finally, we'll get a read on the U.S. consumer with University of Michigan sentiment increasingly an important thing for traders to be watching. And for my final thought, let's get a look at those CPI estimates, because there is a lot of stability. As Bloomberg's Michael McKee was talking about, CPI year over year expected to be coming in at 2.6%, an improvement from the prior reading of 2.9%, almost 3%. Core CPI expected to come in at 0.2%, higher month over month, the same. Core CPI year over year, 3.2%, which would be stagnant from the year before, or from New York. That does it for me. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.